Imagine scrolling through market headlines this morning to learn that silver's global supply, already strained by 5 consecutive years of deficits, hinges not on dedicated mines chasing higher prices, but on the whims of copper and gold production, leaving the metal vulnerable to a hidden crisis that's quietly building toward explosion. This isn't some obscure footnote in commodity reports. It's the underappreciated reality explaining why silver remains paradoxically cheap amid surging demand, potentially setting the stage for a supply shock that catches investors off guard. What if the very nature of how silver is extracted is the Achilles heel no one's discussing, masking a vulnerability that could redefine prices overnight? To appreciate the full picture of what's developing in the silver market, we have to examine the foundational mechanics at play. Silver functions as a unique commodity, blending its role as a monetary hedge with essential industrial uses in solar panels, electric vehicles, and electronics, where its conductivity is irreplaceable. In 2025, demand has reached all-time highs, with the Silver Institute projecting industrial consumption alone exceeding 700 million ounces, fueled by the global push toward renewables and AI infrastructure. The key driver lies in the mining sector, where major operations in countries like Mexico, Peru, and China produce silver predominantly as a byproduct of base metals such as copper, lead, zinc, and gold. This matters profoundly for everyday people because silver's availability affects the cost of consumer technologies and green energy solutions, potentially inflating bills in an economy already grappling with volatility, while investors rely on it as a barometer for broader macroeconomic shifts and a safeguard against currency erosion. The disconcerting element comes into focus when we dissect the supply side. Despite silver's price climbing over 70% this year to above $79 per ounce, new production hasn't surged in response because roughly 70% to 80% of annual output emerges as a secondary product from mines targeting other metals, rendering silver supply inelastic to its own market signals. In the real world, this creates stark contrasts. Physical premiums on coins and bars in US. Dealers hover at 20% to 30% over spot, with delivery delays mounting, while official futures quotes lag the underlying scarcity. Mainstream coverage often highlights demand booms but sidesteps this byproduct dependency, overlooking how it perpetuates chronic undersupply and leaves the narrative incomplete for those tracking the market. Let's break down the supporting figures that illuminate this byproduct-dominated landscape in simple terms. The Silver Institute's data shows that in 2024, global mine production edged up just 0.9% to 899.7 million ounces, with the bulk, over 70%, stemming from lead, zinc, and copper operations, where silver is an incidental yield. For 2025, projections indicate a similar flatline or slight dip, even as deficits widen to an estimated 149 million ounces, marking the 5th straight year of shortfalls totaling over 820 million ounces cumulatively. Compare this to gold, where primary mining responds directly to price incentives. Silver's output ties to base metal economics, meaning if copper demand falters due to economic slowdowns, silver supply contracts regardless of its own booming needs. Regional examples drive the point home. In Mexico, the world's top silver producer, byproduct from copper mines, accounts for the majority mirroring patterns in Peru, where zinc operations dominate, much like how oil byproducts like gasoline don't ramp up independently of crude refining. This statistical foundation launches a sequence of causes and effects that's steadily intensifying the pressure within the silver ecosystem. It starts with the mining economics. Since silver often contributes less than 10% to a mine's revenue, operators prioritize base metal profitability, leading to underinvestment in silver-specific exploration, leaving global output unresponsive as industrial demand from solar, up 20% annually, pulls harder. One outcome cascades to the next. Persistent deficits erode above-ground stocks, pushing refiners to bid higher for scrap and recycled metal, which can't scale fast enough to bridge the gap. As vaults like COMEX draw down to multi-year lows below 450 million ounces, lease rates enter backwardation, signaling immediate scarcity that attracts speculative buying, further straining physical availability. The tension mounts. U.S. policies like the Inflation Reduction Act accelerate EV and solar adoption, spiking fabrication needs independently of mining output, creating a feedback where premiums widen and delivery failures become more common. These market dynamics mirror long-standing behaviors in silver's supply chain, where byproduct reliance has repeatedly amplified crises during demand spikes. Recall the mid-2000s, when industrial growth clashed with flat mining yields, driving prices from $5 to over $20. As deficits accumulated without quick supply response, a 300% move rooted in the same inelasticity. Closer to now, the 2020-2021 surge saw silver double amid pandemic recovery and green incentives, as byproduct constraints from copper mine disruptions echoed today's patterns. In both instances, the setup was similar. Surging consumption met with production tied to unrelated metals, compounding shortages until prices recalibrated sharply. Logic here fosters urgency. When 70% of supply ignores silver's fundamentals, imbalances persist longer, leading to explosive resolutions rather than gradual adjustments. As deficits approach 150 million ounces for 2025 and mining investment lags, the market nears a breaking point where byproduct limitations can no longer absorb the pressure. If base metal demand softens, say from a slowdown in construction or electronics, silver output could contract 5 to 10% even as industrial needs grow, forcing a rapid repricing to ration supplies. A catalyst like geopolitical disruptions in key producers or regulatory hurdles delaying new projects could accelerate this, pushing prices through $100 as fabricators compete fiercely for dwindling ounces. What emerges carries broad implications for global chains and policies. In optimistic paths, elevated valuations incentivize primary silver developments in stable regions like the U.S., potentially adding 50 million ounces annually by 2030, while spurring recycling innovations to close gaps without disrupting tech transitions. Governments might classify silver higher in critical minerals lists, funding exploration to diversify from byproduct dependency. Challenging scenarios involve prolonged tightness, inflating cost for renewables, slowing adoption and straining economies reliant on green growth. Investors face an asset whose volatility stems from this structural quirk, blending opportunity with risk in macroeconomic plays. Yet, as silver's byproduct reality surfaces amid unrelenting demand, one undeniable truth crystallizes. The market's hidden inelasticity is no longer sustainable, demanding awareness before the next supply shock redefines accessibility for generations. As the weight of this byproduct dependency bears down on the silver market, the escalation reveals vulnerabilities that extend into every corner of the supply chain. With industrial demand locked in multi-year growth trajectories, solar fabrication alone projected to consume 20% more ounces annually, the lack of primary mining response creates a widening chasm that secondary sources like recycling struggle to fill, currently contributing only 20 to 25% of total supply. This mismatch intensifies regional strains. In the U.S., data center expansions and EV incentives pull silver independently of global mining cycles, while in China, state-directed base metal priorities dictate output without regard for silver's scarcity signals. The pressure compounds, deficits erode inventories, forcing higher bids that manifest in surging premiums and backwardation on exchanges like COMEX, where deliverable stocks have fallen sharply amid relentless offtake. This buildup integrates with macroeconomic forces that further entrench the inelasticity. Central bank easing and fiscal expansions sustain dollar weakness, channeling investment toward hard assets, yet silver's supply fails to expand in tandem, because mine decisions hinge on copper viability in Chile or zinc economics in Australia. The effect snowballs. As base metal projects face permitting delays or cost overruns, common in an era of heightened environmental scrutiny, silver's incidental yield stagnates or declines, amplifying deficits that now approach 150 million ounces for 2025 alone. Fabricators, unable to wait, turn to above-ground stocks, depleting vaults and elevating lease rates that punish shorts, drawing in momentum flows that push prices higher in bursts we've seen throughout this year. The alignment with silver's historical supply crunches becomes clearer as imbalances deepen. During the 1970s commodity boom, byproduct constraints amid surging industrial needs contributed to silver's parabolic rise, as limited response from lead-zinc mines left demand unmet until prices spiked to attract marginal production. The early 2000s echoed this when electronics growth outpaced mining yields, driving a multi-year bull market as deficits persisted without elastic supply. Current conditions parallel these, but with greater intensity. Not cyclical industrial upticks, but structural commitments to electrification and digitization, locking in consumption growth that byproduct economics cannot match. When primary drivers ignore the metal signals, shortages endure, culminating in sharp recalibrations that resolve the math through elevated clearing levels. With 2025 deficits on track to set records and exploration budgets skewed toward base metals, the market edges toward a critical juncture where byproduct limitations force a reckoning. If copper or zinc demand weakens, perhaps from housing slowdowns or trade frictions, silver output could shrink 5 to 10% even as solar and EV needs accelerate, creating a void that no short-term fix addresses. A trigger like regulatory shutdowns in major producers or cost inflation delaying projects could precipitate this, compelling prices to surge dramatically to ration supplies and incentivize rare primary developments. The outlook reshapes global resource allocation in meaningful ways. Constructively, sustained premiums could shift mining economics, encouraging dedicated silver projects in North America that add meaningful ounces over the decade while advancing recycling technologies to capture more from end-of-life products. Policy frameworks might prioritize silver and critical mineral strategies, funding diversification away from byproduct reliance. More severe paths involve entrenched shortages cascading into higher costs for U.S. renewables and electronics, potentially moderating adoption rates and straining transition timelines. Investors encounter a commodity whose trajectory reflects this embedded rigidity, offering exposure to scarcity themes amid broader commodity cycles. As silver's byproduct foundation strains under unprecedented demand, the unfolding dynamics affirm a pivotal shift. The market can no longer defer to inelastic supply, compelling recognition of a crisis that's been hidden in plain sight, poised to alter accessibility and valuation for the foreseeable future. As the year closes with silver's price holding elevated territory, the byproduct supply constraint continues to exert its influence in ways that reshape market expectations. With primary silver mines, those targeting the metal directly, contributing only about 20-30% of global output, the vast majority rides on the coattails of base metal operations, creating a system where silver's fate is dictated by unrelated economic cycles. This structural rigidity intensifies as industrial demand embeds itself in long-term trends. Solar installations scaling globally under net zero commitments, EV battery advancements requiring precise conductivity, and AI hardware expansions demanding reliable components. The strain propagates. Recycling, while growing, caps at around 200 million ounces annually because modern products incorporate less recoverable silver and last longer, leaving deficits to compound without natural offsets. This progression ties into policy and investment landscapes that further entrench the imbalance. Governments subsidize green technologies, locking in fabrication growth that outpaces mining response, while exploration budgets favor copper for electrification or gold for monetary appeal, sidelining silver-specific ventures due to lower standalone economics. The consequence unfolds sequentially. Chronic undersupply depletes above-ground inventories, elevating premiums that manifest in U.S. dealer rationing and COMEX backwardation, where near-term contracts trade at premiums signaling acute tightness. Speculative interest follows, amplifying volatility as funds chase the scarcity narrative, but without elastic production, each rally risks overshooting before any meaningful supply arrives. The correspondence with silver's past supply-driven episodes sharpens as deficits persist. In the 1990s, photographic film demand, then the largest industrial use, clashed with byproduct stagnation, contributing to price swings until digital substitution eased pressure. The 2010s saw a similar dynamic when solar's rise met flat mining yields, fueling a bull run as investors recognized the inelasticity. Today's iteration surpasses those in permanence, not replaceable applications like film, but essential inputs for irreversible transitions, ensuring demand persistence that byproduct mechanics struggle to accommodate. When supply elasticity remains near zero against multi-year consumption growth, history demonstrates resolutions through pronounced price adjustments. With 2025 projections signaling record deficits and primary mine development timelines stretching 5 to 10 years, the market approaches an inflection where byproduct dependency demands resolution. If base metal economics falter through trade disruptions or demand slowdowns, silver output could decline sharply even as industrial needs intensify, creating a supply vacuum that forces rapid repricing. An external shock, such as environmental regulations curtailing operations in Latin America or cost inflation deterring new projects, could catalyze this, driving prices to levels that finally incentivize dedicated exploration. The ramifications span industries, economies, and portfolios in lasting ways. Favorably, sustained elevations could reorient mining priorities, funding primary silver developments in North America that diversify supply and add ounces meaningfully by the mid-2030s, while accelerating recycling breakthroughs to capture more from urban mining. Policy incentives might elevate silver's critical status, directing capital toward resilient sources. Constraining outcomes feature persistent tightness, inflating costs across renewables and electronics, potentially moderating global transition paces, and testing economic resilience. Investors navigate an asset whose movements derive from this fundamental rigidity, blending defensive qualities with scarcity-driven potential. As silver's byproduct reality confronts unyielding demand trajectories, the prevailing mechanics confirm an enduring transition. The market's hidden supply ceiling is fracturing, compelling participants to acknowledge a crisis that's reshaping accessibility in ways that extend far beyond current valuations. As the calendar turns toward 2026, the byproduct supply constraint asserts its dominance over silver's trajectory with increasing clarity. Spot prices have consolidated following the year's robust gains, yet the underlying inelasticity ensures that any demand acceleration meets limited resistance from new production, perpetuating a cycle where deficits deepen without automatic correction. Primary silver mines, those economically viable solely for the metal, remain rare, comprising under 30% of output, while the majority emerges incidentally from operations chasing copper for wiring, zinc for galvanizing, or gold for monetary appeal. This dependency intensifies as technological adoption matures. Solar modules incorporating more silver per watt for efficiency gains, EV wiring demanding higher conductivity, and semiconductor miniaturization relying on precise deposits. The mismatch propagates. Scrap recovery hits technological limits as products become more durable and silver usage per device declines marginally, capping recycling's contribution and leaving annual shortfalls to accumulate relentlessly. This rigidity dovetails with investment and policy environments that inadvertently exacerbate the imbalance. Portfolio managers, seeking diversification amid equity volatility, allocate to silver ETFs and futures, adding monetary demand to top industrial needs, yet mining capital flows prioritize base metals aligned with electrification megatrends. The result cascades. Exploration pipelines skew away from pure silver plays due to higher risk and lower standalone returns, delaying potential additions that require them spent into 10 years from discovery to production. As inventories dwindle, COMEX stocks trending lower and regional vaults reporting draws, lease rates reflect the strain, entering sustained backwardation that signals fabricators' willingness to pay premiums for immediate metal, drawing in speculative capital that amplifies price swings without resolving the root constraint. The parallel to silver's established supply bottlenecks grows undeniable as structural demand solidifies. During the early 1990s, transition from analog to digital photography, declining film use masked underlying byproduct limits until industrial electronics stepped in, sustaining deficits that fueled volatility. The post-2008 era witnessed similar dynamics when green energy incentives clashed with stagnant mining yields, producing multi-year advances as the inelastic supply curve asserted itself. Present circumstances eclipse those in scope, not substitutable applications, but foundational inputs for global infrastructure shifts, ensuring consumption growth that byproduct economics are ill-equipped to mirror, when the majority of supply remains indifferent to silver's price signals. Imbalances compound, historically resolving through significant upward adjustments to equilibrate markets. With primary project timelines extending into the next decade and deficits forecast to persist, the market confronts a threshold where byproduct dependency necessitates decisive recalibration. If base metal investment falters due to cyclical downturns or shifting priorities, silver output could contract meaningfully even as technological needs escalate, generating a supply gap that demands aggressive pricing to attract marginal sources. A development like stricter environmental standards in major jurisdictions or capital reallocation away from commodities could precipitate this, compelling rapid elevation to preserve industrial chains. The consequences reshape resource strategies, economic planning, and allocation approaches extensively. In balanced scenarios, prolonged premiums reorient capital toward dedicated silver ventures in North America, delivering incremental ounces through the 2030s, while propelling urban mining and efficiency gains that narrow deficits without compromising advancement. Strategic classifications could direct public funding to diversify supply bases. Restrictive trajectories include enduring tightness, propagating higher costs through renewables and electronics, evaluating transition feasibility and economic tolerances. Investors engage with a commodity whose path derives from this inherent stiffness, fusing protective attributes with scarcity-derived momentum. As silver's byproduct framework buckles under irreversible demand currents, the operative forces substantiate a lasting evolution. The market's concealed supply rigidity is eroding, obligating global stakeholders to assimilate a vulnerability that's fundamentally altering availability and equilibrium in the years ahead.